Man, thanks for the availability. I know it's short time, but actually, I think there's a lot flying around, and I wanted to get your take from someone that I follow in terms of sports business news and so on. And the way we usually do these segments or these interviews is that we go a little bit into the personal journey of the interviewee, to know where you come from, how you landed where you are right now. And in this case, actually, it's for you to explain a little bit more about, your JohnWallStreet vertical, and then, the Sportico project and all that. And then to jump right into let's say the current topic, which is what I mentioned before in terms of, this, you know, bubble or boom in terms of alternate means in terms of financing, which I think is interesting, and we'll discuss a little bit that is happening around here in Europe as well regarding that. So I'll basically leave you the floor to actually introduce yourselves, and then we take it.
Okay. Yeah, so my name is Corey Leff, but a lot of people refer to me as JohnWallStreet, which is the name of the daily newsletter that I write. That is not my real name. I get asked that all the time, and I will respond to John, though. A lot of people say,
Really?
Tons of emails to John, so I'll respond to Corey or John.
All right. And how actually that's funny. I mean, how that came about in terms of building that, let's say, persona, right?
Sure. When I started writing, I really wanted the newsletter to kind of reside at the intersection of sports and finance. So I took, Wall Street is obviously Wall Street. And then I took John Wall just because he was the most famous Wall in professional sports. And so that became JohnWallStreet. People think my name is, I'm John on Wall Street or something like that. That's not the case.
And in terms of your background, you've been writing around sports or business before. You kind of try to merge two.
Yeah, so I started my career in sports talk radio. I don't know if you guys have that over there. The idea,
a little bit. It's more, let's say, pundit-like type of conversation.
Yeah, so it's very localized here. That's really what I grew up wanting to do. I had my dream job at 20 years old. I worked at the Fox Sports affiliate in Tucson, Arizona, where I went to college. And, as much as I love sports, honestly, the idea of talking about, whether a 17-year-old kid was going to commit to the basketball program was just not particularly stimulating conversation. There's also not a ton of money in sports talk radio. So I left, but ultimately what I figured out was that what I missed was the platform. It wasn't necessarily radio. It was the idea that there was a platform for me to share my thoughts and get feedback from the community too. And so that's ultimately what JohnWallStreet became. It's just a different format. I'm just writing my thoughts now as opposed to vocalizing them on the radio. In between though, I spent some time in the startup space with a couple different technology-based startups. And then I spent almost a half decade in equity research. And that's kind of where I realized that there was, I knew that the sports world wasn't really covering finance per se, and very little business, kind of beyond sneaker deals and things like that. And this is going back, maybe a half decade or a decade ago. But it was only once I got into finance that I realized that the Bloombergs of the world weren't really covering sports either, and they never really looked at sports as kind of like a real vertical or sector, the way they would treat industrial or consumer or any of the other verticals that they would cover. But sports has grown a lot over the last decade, certainly over the last 2 decades, in terms of value and the amount of money that's being invested in sports, the value of the teams and leagues and companies that participate in sports, and the benefit, from sports being played. So while in the mid 2000s, you could have bought a franchise for $500 million, which is hardly even a micro cap company. Now you have, you can't get a team for less than $1 billion, and most are going for upwards of $2 billion. And we just did NFL valuations not long ago, and I think they had the Cowboys at over $6 billion. So,
crazy.
Just in general, I think we've seen the value of sports and the business of sports increase a lot, and that's kind of opened the doors for not just a guy like myself, but a company like Sportico.
Yeah. Actually, that's funny, and I think we chatted about it in terms of kind of there was like a eclosion about sports business as a news topic, let's say, and I think that also has been driven by the professionalization of sports. So now you see different types of managers or owners getting into sports, and it's people that is highly successful in other industries. More likely than not, it's across entertainment, which is like a close relative to sports. But in any case, it's a juggernaut. And actually,
Yeah.
I wanted for you to take 2 minutes and explain, especially the people which I call friends and family, because most of them are friends and family that actually listen to this, to know what Sportico is. I mean, as you know, I'm European, I'm Europe-based, and we have other sources, but I'm trying to keep up with what you guys are covering. And we'll get into that in a while, because I think there are a couple of very interesting news that could be interesting for people on this side of the pond, actually.
Sure. So Sportico is Penske Media's newest publication. If you're familiar with Penske Media, you might know a publication like Rolling Stone, which is kind of a big music publication here in the U.S. Big internationally, I guess. And so they have about 20 brands, but they really didn't have any sports brands. Even though Jay Penske, who is the CEO, is a big sports fan. Back in June, we introduced Sportico, and the idea was we wanted to really serve kind of the high end of the sports business space. There had kind of been for a long time some established players that had made a business of they're sports businesses, but they're built around conferences. They're conference businesses. They're not news publications first and foremost. And so because of that, everything is driven by the conference business. The CEO of our company, or excuse me, the not the CEO, but the editor-in-chief, comes from Bloomberg, Scott Soshnick. So he comes from a real editorial kind of background, and he felt, certainly I felt, which is why I started JohnWallStreet, was that there had kind of been this hole within the market where there was a lot of people kind of playing to the masses in an attempt to drive these people to conferences eventually. Whereas, we felt like there was an opportunity to speak to the decision makers and people that were not necessarily going to conferences unless they were going to be on a panel. And so, we're just Sportico. We think we're just kind of, certainly it's always been my focus. When I started JohnWallStreet, I was working in equity research full time. And so I had a good job, and I wasn't doing it for the money initially. I really just wanted to build an influential audience. And I always felt like if I could build an influential audience, there's no shortage of ways to monetize them. And I think Sportico feels the same way. So it's very much, a content-driven play. We're trying to put out useful, insightful, actionable content on a daily basis. And the majority of the team focuses on breaking news. I am a little bit different. My newsletter is much more kind of analytical. It's much more Harvard Business Review than it is Bloomberg per se. And so, I tend to try to put things in context, tell people why they matter and how to think about it, or at least one way to think about it. And, I think just generally speaking, though, you're going to find that the Sportico content is more analytical, not opinionated, but certainly taking concepts that may be, that are certainly not necessarily in everybody's day-to-day lives and putting them in a way that people can understand them.
Oh, definitely. And actually, congratulations to you and to the wider Sportico family, because actually it shows in the depth and in the quality of the analysis or the facts that you're presented with, and you kind of get that grasp of what might be behind it or motivating the move. whilst the rest of the media, which serves its purpose, of course, but now it's in a headline pushing race. I mean, I don't know how all of a sudden all of the newsletters have exploded and multiplied, and you get the same headline from different sources and so on. But in the end, it's a bit shallow, so everyone can kind of understand the two basic ideas: who signed this deal and what for. You hardly get a quote in terms of motivations and into the deal, and then you just keep it popping. But it shows that actually the core of those companies wasn't news or editorial, but was actually to be a complement to a wider ecosystem of knowledge exchange, which are the conferences, right? I know we're short on time today, but actually wanted to get your let's say live review on a current topic that is actually very dynamic now in the US markets, and is this model of investment through SPACs. And why I bring it up, because it seems that in most of the cases, at least, the targets of those potential instruments are here in Europe. So there should be some rationale there, and probably is because of valuations, one of them, in terms of the access of having very profitable properties which there are here in Europe at a lower valuation than the American ones. But exactly, it's something that has all of a sudden not being covered a lot here in Europe, but you see other different entities in the ecosystem, like Barca. This past few days, they've been seeding out the idea that they, even though they are, let's say, an associate model, they are not a company, but they are willing to spin out certain productive segments within the club and create what they call Barca Corporate, and actually be able to fund that and fund the club through that. So I found pertinent to have this conversation with you, and actually if you can enlighten us in terms of what is a SPAC and what is the common thread that you're seeing in terms of the destination of that investment.
Yeah, I think there's a couple different ways to think about it. And I'm not particularly familiar with the European markets. So it's a little hard for me to comment on what Barca is doing, but it does take me back a step. I think a trend that we've seen over the last couple of years had been private equity and teams and leagues launching their own private equity arms. I think a lot of that was driven by the idea that we've kind of maxed out in terms of how much revenue we can generate from ticket sales and merchandise sales. And, we're starting to see teams and when they build new stadiums here, they build a whole community around it, retail projects that go along with the stadium. And so it becomes like a real estate project as much as it is as a new venue. And so we're looking for ways to generate revenues and ancillary revenue streams, and private equity has become one of them. And that sounds a little bit like what you referenced in terms of Barca, where they have, if I understood correctly what you were explaining. But in terms of the SPACs, SPAC is really just a special purpose acquisition vehicle to take privately held companies public without having to go through the IPO process. It's a lot easier and a lot less risky to pursue a SPAC. So because there are limitations on what you can say about future profits and such, a company that isn't generating any profits could potentially have a tough time raising money in the public markets through an IPO, a company like DraftKings, right? But because of the ability of a SPAC, they're able to have these conversations in private, and all they have to do is convince the SPAC shareholders to back their idea and their vision, and they're able to take the company public. And we've seen, obviously, once they're public, how much interest there's been in a company like DraftKings. I think ultimately what's driving the SPAC craze, the differentiation in valuations between the public markets and the private markets. The public markets here in the US are particularly frothy right now. And if you're a private company and you're raising money, and there's just a much higher valuation to be able to be captured in the public markets right now. And that's kind of what's the catalyst for all of this activity, if you will. It is kind of interesting that you have this rush of people in trying to invest in sports properties via SPACs, because historically, publicly traded teams here in the U.S. have not done particularly well. You look at, Madison Square Garden is probably like the prime example, and the market cap of the team, the market cap of all their sports properties is probably less than what the Knicks would sell for if the Knicks ever hit the market. But that's probably the reason why, is because, as I just said, if the Knicks ever hit the market, and most people seem to not believe that Jim Dolan will ever sell the teams, he's not going to sell the team. And because revenues, these are not growth companies in terms of, the year over year on the balance sheet. There's not a ton of interest in them. So it's interesting to see that, all these investors are coming in trying to raise money to buy sports teams and properties when the markets have never really, embraced them, if you will. But I think that part of the reason that we're starting to see more public money come into sports is because it's part of a greater cycle. I mentioned up until, and you hit on it as well, throughout the 90s and into the early 2000s, these were the people who owned sports teams were kind of mom and pop, owner operated type of businesses. Only once the valuation started to get up into the hundreds of millions, into billions of dollars, did we start to see we started to see people cashing out and new investors coming in. A lot of private equity came into the sports space between 2005 and 2015. What happens is that private equity, after a period of time, has to generate a return, and they have to exit their investments.
And they have that window between 5-7 years on average, right, to get out.
Yeah, somewhere between 5 and 10 years. And so now we're a decade into a lot of these investments, and these investors are looking to get out. And so now there's, we've gone from your owner operator to your private equity, and now there's an opportunity for the public markets to come in. So you have a whole bunch of things kind of converging at once, but I think ultimately, it comes down to valuations, and the U.S. markets right now are completely out of whack relative to the GDP.
No, definitely. And like anything in economics or in the finance world, I mean, I suppose that we'll soon see that trend reverse a little bit, or at least put the brakes on once, the whole economic thing kind of gets sorted out.
What'll be interesting to see, and that's I think that there's one of the theses behind some of these investors coming in is as the markets turn and people are looking more for security in the markets than growth. What's more secure than a pro sports franchise, right? Like 90% of their season ticket base is locked in year over year. They have long-term media rights deals. For what they lack in terms of growth, they certainly offer in terms of security. So, it's certainly possible that, as the markets trend in the other direction, these investments will become popular within the retail investor.
Yeah, definitely. It looks like it. And going back to the example of Barca, to kind of give you a little bit more in terms of what they are actually after, is that since they cannot sell the club because it's not a company, it's not incorporated. What they are trying to do is kind of spin off productive assets within that, and so they have their merchandising division that they will kind of incorporate alongside their media arm and other productive innovation tech related assets, and right now the estimation is that those divisions actually generate around 100 million euros in revenue. So that's kind of the asset that they will want to spin off and kind of on a multiple of EBITDA and so on. And that is somewhat of a trend, because not only big clubs like Barca, small clubs that also, even though they are incorporated, but they don't have, let's say, the widest appeal in terms of the market, but they do have the same, let's say, economic model in terms of driving whenever we can, but driving fans to stadiums, TV rights deals, and so on. So what they are trying to do is it feels to me like a process of restructuring a defaulting company and actually extracting value from the real productive assets. And they are bundling those and bringing in partners to kind of give them liquidity in exchange of, tech assets or things like that. So it's in an interesting time right now in sports, because right now you are not seeing, a buyer that wants to buy upfront a team just for the sake of supporting their team, kind of the old model. And it's, very on a very conscious, financial decision, looking at a speculation also as well in terms of what the potential growth value of those assets could be.
Yeah, there's been a lot of American money invested in U.S. soccer, or excuse me, in European soccer, and I know even another colleague of mine wrote an article today about Red Bull potentially investing in Fenway Sports, and they of course own Liverpool, so there could be another some U.S. public money coming into European soccer as well. But I know there's been a lot of private equity interest in the space. And, I think just generally speaking, we're going through such a tumultuous time. I think there's going to be a lot of turnover in the ownership ranks. People that have, I wrote about this not long ago, but we had because most of the wealthy people got wealthier during the pandemic, we hadn't really seen much, if any, at least on the U.S. side, ownership, team ownership sales occurring. Because the markets have continued. These people are wealthier than they were before. I think that as this pandemic drags along, I think you saw Major League Baseball came out yesterday and said that they have over $8 billion.
That's a big bill.
It's a big bill, and it's a huge bill if you have if you're losing $200-300 million, $300 million a team, or whatever the number was. So yeah, it's I think we haven't seen the full impact yet. And I think that if we don't get a vaccine where fans can return to the stadiums and we can play full seasons, you're going to start to see, more team sales and change in ownership. And it'll be interesting to see if, where that money comes from.
No, definitely, because after the health crisis will come the economic crisis, and some of those owners, 9-to-5 businesses actually will be affected. And when you are short on cash and you have this toy, probably that's a way to capitalize your state and things like that. Corey, I don't want to take much of your time. I know you are busy today, but definitely I think that we'll kind of make this type of intermissions and short interviews with you to kind of take the pulse on what's happening down the road.
Yeah, I'd love to. Please, reach out whenever. I'm always happy to do it. I love the hat. I also go with the branded hat. So
there you go.
This was fun. I'm always happy to have these conversations, and I'm always happy to be a resource. If I can ever be of help, please reach out.
Excellent. Likewise, and I wish you all the best, and stay safe over there. Speak soon.
Likewise. Thanks so much, guys. Talk soon.
This episode is brought to you, as always, by The Connect. The Connect is Raida Luis Baez. Follow the Intersection podcast in your favorite podcasting platform. Leave us a review and share it with a friend. This will really help us be found by more of you interested in the topics of sports marketing and deal making. Until the next one.